Our topic is prediction markets and how they intersect with decentralized insurance. My name is Ron Bernstein. I'm an investor and an advisor to Etherisc, and I'm also the founder of a software development company that's building tools for decentralized marketplaces. To my left is Jack Peterson. Jack is the founder of Augur. And to Jack's left is Martin Köppelmann. Martin's the co-founder of Gnosis. So I'd like you guys to introduce yourselves a little bit and just say hi and talk about your projects and how it kind of correlates to prediction markets and the crossover to insurance. Jack.
Okay, well, yeah, I'm happy to be holding the mic, so I guess I'll go first. Yeah, so like Ron said, I'm founder, lead developer of Augur, and Augur is a decentralized prediction market platform. We're built on the Ethereum blockchain, and I guess the relevance to this conference is prediction markets can be used for insurance, really like any other derivative or like a futures contract. The example I like to use is, I live in the San Francisco Bay Area, and we have there's a lot of earthquakes in the Bay Area. And, the one thing you can do is, if I'm like a seismologist and I know a lot about earthquakes, I can place a bet on, the probability of there being an earthquake in the Bay Area. Or if I'm a normal person, which I am, and I don't have any special knowledge about earthquakes, but I'm concerned that there might be an earthquake, I can, and say there's a prediction market, will there be an earthquake of magnitude 8 or greater in the Bay Area before the end of the year? Well, I can place a big bet on yes as a way of hedging the risk of the earthquake occurring. And then, if the earthquake actually happens, okay, well, maybe I lost out, but I would have made money on the prediction market. So it can be used so basically by making a bet that it will occur, I've bought myself some earthquake insurance.
Right, and that's very much the parametric insurance use case. There's a marketplace that you can take advantage of, you can pay a premium, and then in the hopes of getting a payout. Mm-hmm. And Augur as a market structure enables those types of markets to be very broad or very granular.
Yeah, that's exactly right. And because Augur is decentralized, one of the really nice things about being decentralized is that you have access to a truly global liquidity pool. So hopefully that would result in lower insurance premiums.
And Martin, tell us about Gnosis. And one of the aspects of Gnosis I think that you focused on is the modularity of the project. So without stealing the thunder, introduce and tell us about what you're doing.
Yeah, so Martin, working with Gnosis. So, well, in principle, we're doing very similar things, but our focus is specifically on this platform aspect. And to us, the platform aspect means that all the components should be very modular. And we have even switched, or recently switched our language, or we haven't fully decided if we really do it, but we said so far we are a prediction market platform, and that might cause some confusion. Or there are really many things you can do with prediction markets, and maybe it's better to use the word tokenized conditional payments, because that at the core that's not better. Well, I mean, so just in some cases the reaction, if we say we're doing prediction market, then the reaction in some cases are okay. So you're doing gambling and it's illegal. So those are the two reactions that can come to prediction markets. So tokenized conditional payments. I mean, so we really see, or it's kind of also that's a hope for in this context, that we can agree as an industry at some level on a standard, like the token standard. It's really just this very base level that, well, if something is happening here, then the payment will flow in this direction, and if something else happens, then the payment doesn't flow or flows in another direction, and that's kind of the conditional payment. But the interesting part is, and that's I think what the token does. I mean, that is what insurance does anyway. But the interesting part is that those those potential claims, they are now tokenized, so you can also trade them. Or so you could sell them even, or you could buy the insurance claim, but you can even, or potentially at least on this basic
dynamic.
Right, you could sell your claim, or you could re-bundle those claims, and it gives you great level of flexibility. And our hope, or our goal also with Gnosis, is to find a standard for this basic, basic conditional payments, and then everyone in this industry, like the token standard, would just at that level use the same thing, and then all the tools that we and others are building. Protocol level. Right.
So one of the concepts that I wanted to put out there is, if you think about a fully decentralized system where there's no leaks at all, and you relate that to insurance, you almost have this concept where you might be eliminating completely the concept of claims adjustments, right? There's no more claims adjustments. The event happens or reports on it, and parties get paid based upon the parametric position that they have in the marketplace. So in that kind of thinking, from perhaps the end user to like the big trading firms that might trade that risk, talk about some of the micro markets that might spring up in prediction markets, and then some of the macro markets, and take it anywhere you want it to go with it.
Sure. Yeah. So I would say, there is definitely a market for those completely parameterized insurances, parametric insurances, where you don't have this claim adjustment, and I think there was a flight delay app. I of course used it. Is a nice example, but already there you can also see a bit of the potential problem. So, for example, I had a connecting flight, true story, from Berlin to Frankfurt and so on. So, but I could book the flight insurance for the last flight to Cancun. But my first flight was delayed, so I missed my second flight. So in the end, kind of so what really matters to me as a traveler is not necessarily
that specific leg.
Is one flight delayed, because if the first is delayed and the second is also delayed, and I still get my connection, well, then all is fine. Or well, the damage is not that big. So there are, I guess, countless examples of where it's not so easy to have one oracle that just reports, and where you really have to handle the specific case. And those are, of course, things where prediction markets are not maybe too interesting, because prediction markets are specifically interesting if there's a fungible or event where trading on it is fungible, and then kind of this tokenization of those claims, then that makes a lot of sense. If it's really an individual thing, then you don't get too much benefits from it.
Micro versus macro.
Yep. Right. I mean, I think one of the core issues that you face for kind of, is it worthwhile to create a prediction market on something, is just is it something that where the crowd can reasonably be expected to have information about it. If you can make a prediction market about, how much rainfall will there be next year in some country, say in Africa. Now, that's something that's a reasonable prediction market, right? Because there's real data about that. People can look it up after the fact, and there'll be interest in trading on it. Whereas if you get a prediction market that's too fine-grained, for example, prediction market on how much rain will there be on some specific farmer's little plot of land, it's unlikely there'll be any trading interest in that, and it'll also be something that's tricky to resolve after the fact.
I would partially disagree on the second part. So I totally see, and also not necessarily the distinction between micro and macro, because I could totally see that we will have so much sensors in the future that we know specifically how much rain is exactly on
IoT sensors, automated registers.
Right, and then, I mean, the participants in the prediction market would not necessarily be the crowd, it would just be algorithms that would compete, and machine learning, different machine learning tools. So it can be, I think there will be a future where small tools or maybe tools or in the farming example, maybe the farmland itself will have some whatever, and it kind of really you have a micro insurance for will it few dollar payouts or cents payouts, and you could get all those things really fine grained.
Right. So maybe even some concept like the wind meter is actually registering the wind and hedging some contract automatically, you know, based upon some potential weather outcome.
Yeah, I actually hadn't considered the IoT aspect of it, so that's maybe that's not such a good example.
Yeah, well, just another one. So for the wind, so we have already the concrete, example of electricity providers. So of course you trade your electricity in the future, and therefore you want to exactly know, well, how much electricity do you produce? That depends on how intense will the sun shine if you have solar, how intense will the wind be.
And they make adjustments in real time.
Right.
Degree, temperature, days, and they you know, allocate power differently.
And you can perfectly then hedge so you make an assumption. We assume the wind will blow so strong, so we will produce so much energy, so we can already sell it on the market. And if we can't produce it, and then so totally see also kind of a micro, and even not sure if you then in the end would call this insurance, I guess. So I would say the distinction is things that are publicly observable and are publicly measurable on the one side, while kind of how big your damage in a car accident is or stuff like that, there I wouldn't see, or there of course you have also privacy concerns, and so on that level, on those cases I can't see how that would be anytime soon come to,
Everything is in development and underway. Did you have a comment for this? Because I have a question I wanted to ask.
No, go ahead.
So on the macro side, and this is something we've only lightly touched on a little bit today, but one of the things we're not talking about is insurance as a speculative asset class, perhaps, and the ability to add risk takers into this marketplace. And the impact of risk takers in open markets, do you think they will either increase the number of assets that are traded or perhaps reduce premiums at the end of the day? Will they actually add fluidity to these markets and somehow make them better?
I mean, my guess would be yes. I mean, you add more risk takers to a market, you add more liquidity to a market, you create a global liquidity pool. I think it's very reasonable that you could see lower insurance premiums as a result of that. And yeah, just more liquid markets in general.
And more granular markets, perhaps.
Yeah, that's true too. I mean, I guess like the previous discussion illustrates, you know, given the right kinds of data as observable inputs, you know, you could have a huge number of markets at many different levels of granularity.
Yeah, I mean, the hope clearly is that more liquidity and more efficient markets and more open markets will lead to better rates.
So one might say that's a social benefit to traders and hedge fund participants and speculative crazies that are trading crypto now and want, you know, some other thing that they can trade. But how do we imagine insurance and the improvements by transparency in insurance and the way this market may grow, how is that going to translate into real social benefits? Like, what is an actual use case, human being 2 feet on the ground?
Yeah, I think or kind of the main thing is that you can more specifically insure insure yourself against all kinds of risks, and at a just much better price. So instead of having one counterparty, kind of one insurance company, or maybe a few offering specific things, you can just have anyone on the other side who has an opinion about the likelihood, or someone who basically has the opposite risk. So
Speculator.
well, yeah, I mean, maybe a speculator, but I see it more data scientists and yeah. Or again, someone who has the opposite risk. But
Yeah, I mean, I completely agree with that. I think, at the end of the day, if you're cutting out middlemen, I mean, even if your counterparty is just a speculator, as someone who's interested in buying insurance, presumably what you care about is just getting, the best price that you can on your insurance. So I think this will help with that.
Cool. And just a last comment, if you think forward 2, 3, 4 years, because that's like a long time, but it's not that long in crypto time, how do you think prediction markets and insurance on the blockchain might play out? Like just wild bar conversation about that.
A wild bar conversation.
As wild as
I guess my prediction in that time frame would be that the sort of larger scale events. Going back to the farming example, I think things like how much rain will it be in a country. That's a very reasonable thing to see in that time frame. Things that are much more granular, I think those will, to the extent that there's data available, those will come online and attract trading interest, as time goes on.
yeah, similar. So right now, all those micro things are totally not possible because transaction costs are too high, gas costs are too high, so currently, for example, Gnosis, it costs roughly a few dollars to create them, or $1 or $2. I mean, depending on
3 or 4 years from now, though, we're looking at.
Sure.
Does a farmer in Africa who farms 1 acre, do they actually have access to purchase a mobile policy and protect that 1 acre because they need a quarter-inch of rain? Is that part of our future?
Part of the future, definitely. 3 years, I wouldn't bet on that.
If you guys have any general comments that you wanted to say about your projects and how it relates to insurance, or we could open it up to the audience and get some Q&A.
Yeah, which maybe a short comment. So again, as I said in the beginning, we are very aware that insurance is a much more complex thing than just what we do or the prediction market element, but we think this element is conditioned or seeing insurance claim or products as this tokenized conditional payments can be very helpful because it can create synergies, and that's one part of what we want to do is kind of create this base layer. And also, this base layer is just a standard, like the token standard, so there will be no fees involved or whatever. And I would hope that everyone, or would invite everyone to look at what we offer here and discuss how we can shape that. And I think then it would make a lot of things easier.
Yeah, I mean, I'm in total agreement that standards and interoperability, especially with sort of intra-Ethereum, are pretty important things. And actually, our two projects use interchangeable shares of markets.
Outcome tokens.
Yeah, outcome tokens are just standard. We're called ERC20 tokens. And in fact, our teams collaborated on creating that standard in the first place. So.
Okay, you want to open it up to the audience? Do we have questions in the audience? Yes, we do. Very good. You first and
Perhaps a bit more of a comment, but I think the main opportunity for prediction markets is around price discovery and also efficiency of capital, I guess. So, and at the moment I see significant challenges on both. And I think if you're really going to try and tackle an insurance industry with massively complicated actuarial models for pricing that are established with millions of different cells, and the efficiency of the insurance industry where it doesn't have to hold full collateralized contracts, I think both of those are pretty big challenges for prediction markets to add value in the insurance context. But I think it's doable, but I think it requires focused effort to get there.
Hugh, is that the prediction market structure, or is that the nature of decentralization that you think, causes that to be a conflict?
Well, perhaps it's a bit of both, but the prediction markets are set up primarily to have a fully collateralized.
Right.
We've heard that you can do it in alternative ways, but I think you need focus there because the collateralization level of insurance companies is very tiny, like single-digit percentages, not 100.
Yeah, it's surprising.
Yeah. So you need to be able to address that, and the number of different cells or the number of different markets that you would need to build a full pricing algorithm is phenomenal on something like a natural catastrophe cover. So I think you can potentially do it, the architecture's there, but I think you've got significant challenges and focus to get there.
Yeah, I think, so on this question of collateralization, it's 100% clear that kind of the naive use of prediction markets is not possible for insurances where everything's 100% collateralized. But I think you can, but I think the nice thing about that it forces you to make it very explicit. So if you use this model, then it's very clear what is actually the collateral, and the collateral can again be a basket of other claims. But again, you make the process that is now implicitly in place, or maybe somewhat it becomes very explicit, and you exactly know what you get and what is your risk, the risk model, and again you can also, the collateralization is super dependent on independence of the outcomes of the events that you're insuring, and that is something you can actually kind of prove with a prediction market. So you can create again those conditional markets where you show, okay, those two things are independent. So I think at least you can get a increase of transparency, or also accountability and eventually efficiency.
Step in the right direction.
Right.
Yeah, one thing I'd add to that is just that, decentralized prediction markets by their nature are just open public markets, so anybody can participate in them. And presumably people with the best information will want to participate. So for example, they're completely open to insurance companies participating in what they think the proper price should be, what the proper probability should be. Hopefully that would be a useful input to decentralized prediction markets as a sort of a data feed.
The crowd wisdom.
Yeah, exactly.
Yeah, I'm experiencing a strong cognitive dissonance here. I'm going to try to explain. So the narrative around prediction markets so far was always that the price in a market was the best estimate of the probability of an event given all available information in the market, also hidden information. Insurances are something else. I mean, jokingly, you could say that an insurance is a bet that something bad will happen. But in reality, there's a fundamental asymmetry in insurances. On the one hand, the asymmetry lies in fact that it's about events with a low probability, but with a high impact. And so there's a lot of people who are not able to bear that high impact, and they want to pay a price to insure against that low probability event. That price is the premium. So in insurances, the price in the market is not the reflection of the information we have of the probability of an event. And I don't see how, I mean, technically you could say it's the same thing, but functionally these are totally different things for normal people, so I can't see how we can explain this. And I mean, and calling them tokenized conditional payments and saying that the price involves a premium depending on the context, I'm not sure that is going to work, so please help me out here.
Is your question about the low probability outcomes and the premium for those things being so low that it's very difficult for them to mimic the real probability of that outcome occurring?
Now, my question is about the fact that in the panel now you actually equate prediction markets with insurances, whereas fundamentally I see these as different things.
Yeah, I mean, maybe it would be better to say that prediction markets can be used as a form of insurance, rather than saying that they're literally the same thing. I maybe, correct me if I'm misunderstanding your point, but I think it's a fair point that people are not, in general, very good at estimating the probabilities of very unlikely events, right? The whole notion of a black swan and people being unused to thinking of this sort of tail risk. And I mean, so one point that you made I think is fair is that, this notion that price is probability in prediction markets, it does rely on participants in the market, being able to, not making systematic errors, like not all systematically underestimating the tail risk, because, well, if they do, then the price and the probability won't completely overlap.
There's no data behind this, and it's just a hunch, but kind of what I always say as an estimate is everything that is less likely than 5%, that's maybe hard for a prediction market to find a good market price, because then you, in addition to kind of just a pure thing of what is the likelihood and therefore what's the price, you also get things like what's the value of capital. So it's
pragmatic impacts.
Right. So let's say 5%. So then, of course, there are many insurances where you insure against events that have lower probability than 5%. And yes, then I think it's difficult. But again, first of all, there are, or at least I see many things. So whether things where 5% is totally, or 5 to 30% or something like that is totally reasonable. And then again, you can basically have those meta markets where you don't ask what's the likelihood or kind of a single insurance claim happening, but you have a basket of things, and then you can have a market of, well, what's the likelihood that at least so many will trigger some payment, and then of course you can come easily to likelihoods where prediction markets work very well, and I would say again just more than 5%.
Less, greater than the lottery ticket outcomes.
Yeah.
I would say for us in insurance, this 5% is exactly the border under which insurance makes sense, because insurance is about pooling of such low risk events. So, for example, a house insurance for fire is far below 1%. Yeah, so you should pay a very little premium, but the payout is huge. You get a new house basically for payment of some maybe $100 per year. But I think the prediction market is also very complementary to insurance in this sense, and I found it very interesting that you say, this was a question of mine, how you get liquidity for prediction markets, and it brought me to the insight that maybe the liquidity in future will not be given by natural people, but by machines. Machines betting on prediction markets. And this would be my question, what would your expectation? What share of the whole prediction market volume is done by machines in 5 years?
It depends also what are machines. So a trader that uses kind of some algorithm you would also count that as a machine. Yeah, sure. Then quite high, so very high. 80-90%.
Yeah, it's a huge factor, obviously, financial markets. There are sports betting syndicates.
Right, I mean, even today, so on sports betting, I think most of the volume, or kind of 99% of the market makers are, of course, computer programs. Right.
Yeah.
Yeah, I mean, I guess my prediction would be roughly whatever percentage of robo traders make up.
But I think this is an important change, because classical insurance always thinks about natural players, natural people who are insured, and natural people who are managers, an insurance company who are making decisions on a table, sitting with a pen and pencil. And I think this is an important change, because the whole blockchain will see much more mechanical interaction than human interaction, and I think the whole legal system is not fit for this, and I think we'll need new legal structures to cover this new situation. Yeah, this is completely new.
All the profits of the insurance companies to date will be squeezed into the fact that the prices were wrong the whole time.
Of course.
Okay, thank you. We have one more question here.
Hi, does tokenized conditional payment system do anything to address insurable interest in the insurance space? But insurance interest meaning is that I mentioned in the morning that so currently the difference with insurance and the tokenized conditional payment market, in my understanding, is that in the prediction market, anyone can join, so that there's always gambling aspect. Whereas for insurance, you only recover your loss. Does tokenized conditional payment can address something, or it's different, separate problem?
Right, I would say here, on a base level, or kind of on a protocol level, of course, we design systems, or try to design systems very general. So I would compare it to HTTP. So on the base level, you're just trying to, but on higher levels, of course, you can add additional rules. So of course, you could have markets where you would say you need to be identified to participate, or you need to, well, have a
More specific outcomes.
right. So all of what is done today is possible. I mean, how insurance works today. That is of course possible. You can build all that stack on that tokenized conditional payments, but ideally, you can leave some things of that stack out, and to make things more efficient. On the specific question of who should be allowed to trade, yeah, that is a good one. And again, at our level, we are pretty agnostic about those things, but of course, you should think about. Of course, you have to think about fraud and misincentives, and you don't want to create systems where you create really bad incentives. That's all possible. So what we like to do to think of is kind of different parameters. So one is the cost of influencing an outcome. The cost. So for example, if you predict the weather, that's pretty safe. So you don't worry about that someone, just because they may have a kind of skin in that outcome, that they would then kind of maliciously influence the outcome. So the cost of influencing the weather is pretty high, so that's safe. If you insure yourself against something or an event, even a flight delay, I mean, of course you can make things that will delay a flight. The costs are, rough estimate, maybe $500,000, something like that. So
A phone call, one phone call.
oh, right. So, okay, but it depends on, so this phone call can have more costs later. So anyways, so I mean, in the model you would just kind of try to give it some value, and then you find kind of different markets, some that are purely observing, and I think those should be free for all, and you just try to get the best numbers. But some are, but in some markets, the market itself will then have kind of there's a feedback loop between the market and the event happening itself. But that's something you don't want to have in insurances. So yes, you have to think about the ratio of. I mean, also the insurance should not be much bigger than or kind of you don't want to have a $10 million insurance on a house that's only worth $1 million, and then have suddenly a huge incentive that this house will burn down. So of course, yeah. So no good answer. Just it depends, and it's possible to build those things on top.
Do we have any more questions in the audience? If not, I'm happy to take that opportunity. In my opinion, the relation between prediction markets and insurance, there is also another notion that maybe has not come through so much until now. I always say that if we have no other means of learning about reality out there, so what has actually happened, we can still use prediction markets. Yeah, for example, my main example is the car crash, and there might be people who have seen this. I mean, of course, we come into terms of how many people can we have and granularity. But in general, can you see prediction markets as a part of a claims adjustment process, replacing something like an oracle? What is your take on this?
Well, my view is that an oracle is an important complement to a prediction market. I think that a prediction market becomes sort of self-referential if it attempts to operate without an independent oracle. I think that, so I think it's important to have the oracle be something separate from just what is the price in the prediction market, if that makes sense.
Yes.
Yeah, I would argue also in a very similar direction. So people sometimes think of prediction markets as a potential for oracle, and it might be possible. Well, it clearly gets very complicated or very dangerous also, because prediction markets rely on the fact that at some point you can clearly judge that happened or that happened, and then kind of until that point you can already get a good estimate. But if that point never comes and just relies on, then you get into very different kind of game theory and kind of get more this Keynesian beauty contest and stuff like that. I would be careful with that.
So the conclusion here, it's dangerous.
Yeah, so in principle, prediction markets assume at some point you will clearly say that or that.
You know the outcome.
You know the outcome. At some point in the future.
Yeah, I mean, it's important for the market to know that it will ultimately converge on reality. And yeah, in order to do that, the oracle really has to be an independent mechanism.
As an endpoint.
Yeah, that's right. So
the question was more, can we use it, or can we use prediction markets where the outcome is only in the prediction market and there is no... So basically to learn about reality from watching the prediction market converge. That was my assumption, maybe naive, but that's...
The difference between subjectivity and objectivity is tough. Like claims adjustment, there is some expertise that's required to assess the impact of the weather and, this result happened. Whereas an oracle, in many regards, this is the data that occurred, and this is the outcome that occurred, and this is the criteria for the market, and that's a very black and white outcome. So there's going to be some meshing of objectivity and subjectivity, particularly when, you know, money is involved with people's lives and some of those social outcomes.
There's one trick you can do. So I just said, okay, it needs to be clearly kind of observable or clearly resolved at some point. It is even enough that there is a chance that it will be clearly observable or clearly at some point. So one example we had, a use case for a prediction market and for conditional markets was what's a city where they had problems with the water because it's all
Flint.
Flint, right. So in Flint they had this, or they still have this problem that, I don't know, the water is bad. And so they wanted to make predictions, where are lead pipes, right? And, well, you can find it out by just digging a hole and, well, looking it up. But that, of course, is costly. So you have, whatever, let's say 10,000 households, and what you can do now, you can, and actually someone, back to this question, a machine learning professor was looking into this problem and wanted to do with machine learning with his students, and they should kind of predict where lead pipes are and where not. And you can do a prediction market on all those 10,000 households and get what you were asking for, an estimation of the reality. And it's enough that in the end you randomly just select, let's say, 20 where you actually digs a hole and then resolves the market, because then every of those 10,000 is traded under the assumption that there is a chance that it will be resolved and so on. So then you already kind of get the wisdom of the crowd or wisdom of the market or intelligence of the market or however you want to call it. But you only have a fraction of the costs of kind of resolving it or
Starting points.
Sorry. One thing I want to add is that with regard specifically to using prediction markets as sort of a tool for doing claims adjustment, as long as the prediction market in question actually does have an independent oracle, and an insurance company, which is a separate entity from the prediction market itself, could conceivably use the prices in advance of the actual outcome to do claims adjustment. Keeping in mind the important caveat that the odds might not actually, reflect the final result. If something has a 95% chance of happening, it also has a 5% chance of not happening. So.
And just to finish the thought. So on the same thing with the lead pipes, you could of course do on car accidents that kind of you have all those 10,000 cases, and in the end you will only kind of investigate 20 really deep. But because there is a chance that yours will, and so on the market might, I haven't thought about that in detail, but something in that direction.
I think that's actually a very good example. I mean, we see something similar with the hurricane damages now. Their biggest problem is that they don't have enough claims adjusters. So in fact, it would help them a lot if they can do just what I would call probabilistic payouts. And just the chance that some of those are checked later, on a deeper level with real claims adjusters going there, it would speed up the process a lot, and that's actually a real problem that begs solving. So to come to an end here, and I think I'll leave it for you to wrap it up then. I would like, I'll leave it to you to wrap it up, please. Okay. So one last question, because the panel is about insurance and prediction markets. Question to both of you. Do you see any insurance applications already on top of one of your platforms? And if yes, I would be happy to learn about it. If no, when do you think we will have those, and what is hindering that right now?
So we have one thing, and I don't know if you can count this as insurance or not, but one thing that is currently teams building on Gnosis is kind of a token, ICO token insurance. So the idea is, well, you participate maybe in some of those token sales, and you can essentially buy an insurance or make a bet that they will not reach specific milestones. So I mean, they promise, okay, we will do this and this and that. So you could have a market. Will they reach it? And of course, you could kind of buy this bundle. You buy into the token sale, but at the same time, you also make insurance that if they don't reach whatever, then you get part of your money back. So, don't know if that counts as insurance, but that's.
It does.
I have some happiness insurance. I have some happiness insurance on the Dodgers.
Yeah, we don't have, as far as the teams that I'm aware of that are building things on Augur, I don't think we have anyone building something that's explicitly insurance. I guess my main answer would be that not until we're launched, which will be soon. But until we're on mainnet, we can't buy insurance off of a testnet application. I suppose it's true for both our products.
But I know a guy.
But Ron knows a guy.
Ron, last words to you.
Yeah, thank you all very much, and thank you guys for hosting this conference. Terrific job. Thanks.